Welcome to This Explainer. Today, we're diving deep into the precious metals market, and we're specifically looking at why gold and silver are currently defying conventional financial wisdom. We're going to break down exactly how you can navigate these, frankly, highly turbulent financial waters. If you've been watching the charts lately, you already know something fundamental has shifted. Well, today, we're going to use the data to uncover exactly what that is.
You know, there's this brilliant analogy from a veteran market technician that perfectly anchors everything we're looking at today. It goes like this. When you're standing on the back of a ship, watching the waves churn, you can easily tell which direction the boat is currently drifting. In the markets, those waves are your price charts and technical patterns. But here's the massive caveat, right? You can watch those waves all day long, but only the captain knows when they're actually going to turn the wheel. So today, yes, we're going to look at the waves, but more importantly, we are going to look at the captain.
Let's jump right into Section 1, the broken golden rule.
So, the traditional rulebook for investing in precious metals, it's basically been thrown out the window. We are witnessing a massive paradigm shift happening right in front of us. Now, the old conventional wisdom tells us that war and geopolitical instability send investors rushing into gold as a safe haven, right? We've obviously seen renewed conflict tied to Iran and disruptions near the Strait of Hormuz. In the past, this would be a massive catalyst for a gold rally, but under the new reality, instead of lifting gold, these geopolitical events are keeping energy prices elevated, which causes inflation to spike. And that inflation spike accelerates fears of interest rate hikes. So rather than acting as a safe haven, the metal is actually being weighed down. Geopolitics are literally taking a backseat to inflation data.
And here is the fundamental why behind this whole new rule. Gold is a non-performing asset. It pays absolutely no yield, zero interest. So when inflation ticks up and the Federal Reserve starts talking about raising interest rates to fight it, guaranteed fixed returns on things like treasuries suddenly become highly attractive. That yield acts like absolute poison to gold's appeal. Capital is just naturally pulled away from bullion and into bonds and cash where it can actually earn a guaranteed return.
Let's move on to Section 2, reading the market waves. Building on that macro shift, we have to look really closely at the candlesticks to see where this boat is drifting on a micro level. Usually, short, lower wicks signal resilience. It means buyers are stepping in incredibly fast to reject deeper losses and snap the price back up. But right now, that pattern has completely flipped. Those lower wicks have vanished. Instead, we're seeing the real bodies of the candlesticks closing solidly lower, right near the session lows, with far less recovery. Basically, this tells us the buyers who used to swoop in are currently just sitting on the sidelines.
The crucial tipping point here has been the $4,000 mark. For a long time, $4,000 acted as this incredibly strong psychological floor for gold futures. But because those fast buyers have disappeared, this critical level has been completely broken and tested multiple times. The market is just no longer viewing this as the impenetrable floor it once was.
And the downward momentum is really accelerating step by step. First, as we just discussed, we had that clear break below the $4,000 mark. Then, for step 2, we saw the market testing lower levels, with wicks reaching down near that $3,954 area. But because those real bodies couldn't sustain a recovery, it brings us to step 3, falling straight toward deeper secondary shells, specifically eyeing that older October low down around $3,932. The price action is just being pulled past recent tests with very, very little resistance.
Which brings us to our revised technical support. If this follow-through selling continues on a closing basis, meaning if the daily charts keep finishing near their lows without those long recovery wicks, our technical models suggest the floor drops all the way down to $3,900 on the low end. That is a massive recalibration from where we were just a few weeks ago.
All right, let's get into Section 3. The captain turns the wheel. So, while the charts show us the waves, remember that fundamental monetary policy is the captain steering this ship. And lately, the Federal Reserve Chair has adopted a distinctly hawkish tone, stating solidly that any inflation level above 2% is strictly unacceptable. They've made it clear they are willing to take whatever steps are necessary to put a ceiling on rising inflation. And their primary tool to do that? Interest rates. This means rate hikes, which we haven't really discussed in quite some time, are officially back on the table. This completely flips market expectations from anticipating rate cuts right back to bracing for rate hikes. And traders aren't just trying to predict policy out of thin air. They're reacting to these fundamental statements. Right now, depending on the data of the day, market participants are pricing in a staggering 50, 60, or even 70% probability that we're going to see a rate hike before we ever see a rate cut. The dominant force here just isn't chart geometry anymore, it's monetary policy.
Because the probability of a rate hike has spiked so dramatically, the intense focus among market participants has shifted entirely to when the captain will actually act. All eyes are scanning these specific windows. Are they going to act at the next immediate FOMC meeting? Will they hold off until September or maybe December? Every trader is studying this horizon because the second that wheel turns, the entire market shifts with it.
Next up, Section 4, Silver's Amplified Swings.
Let's pull up alongside our main vessel for a second to examine the smaller boat traveling in tandem. It's so vital to understand the dynamic between these two metals. Gold is the larger, more liquid asset, so it ultimately sets the tone for the entire precious metals group. But silver? Silver acts as a highly speculative instrument. It rarely moves independently of gold, but man, it moves much harder. In a bullish stretch, silver typically outperforms gold on a percentage basis. But in a bearish sell-off, like the exact one we're tracking right now, silver typically underperforms, dropping by a much wider margin. The percentage swings are violently amplified.
And this correlation is playing out perfectly in recent months. Step 1. Both gold and silver hit their multi-month highs, their apex, together earlier this year, right around March and May. But since then, they've rolled into a sustained correction. Moving to steps 2 and 3, both metals are currently tracing a textbook technical pattern of lower highs followed by lower lows. It's just a very clear, defined structure of a market under severe, sustained pressure.
Finally, let's look ahead to Section 5, Navigating the Horizon.
So, knowing the broken rules and the shifting charts, what actually awaits us? Well, there is a massive divergence in expert opinion right now. If you look at the 2026 forecasts from major banks, they are starkly divided. On one hand, you have bearish models warning of deep declines down to the $3,300 or even $2,800 range if selling accelerates and rate hikes actually materialize. But on the exact opposite side, bullish models are targeting massive highs of $4,900 to $6,300. Why such a huge gap? Because these extreme targets hinge entirely on one single factor: whether the Fed ultimately hikes rates or pivots back to renewed easing.
As we look toward the immediate horizon, you've got to keep a very close eye on September. During the summer months, a percentage of trading pools always move away, and volume thins out. But come September, those hedgers, market analysts, and primary traders return to their desks, heavily studying the markets. This brings a huge spike in trading volume. And historically, that volume spike doesn't usually create some magical pivot. Rather, it tends to forcefully continue the market sentiment that preceded it.
Which really brings us to our final and most important point. Gold and silver aren't ignoring the world stage, the wars, or the headlines. They are simply filtering every single geopolitical event, every jobs report, and every inflation metric through one critical question. What does this mean for the Fed? Until the Federal Reserve acts, precious metals remain hostage to the data. So the real question you have to ask yourself is this: when the captain finally turns the wheel, will it be in time to save gold's floor, or will that $3,900 support simply be the next wave to break?